Radio.
All right, John.
You're about to hear a revolution in talk radio, Liberty Talk Radio, where the critical thinking will defrag your mind of propaganda-ridden viruses induced by mass media news programming. No BS here, just the facts.
And now we present to you America's quintessential iconoclastic anomaly. Wow. In talk radio, your host, Joe Cristiano.
Welcome, everyone, to Liberty Talk Radio, America's libertarian voice. I'm your host, Joe Cristiano. We're broadcasting from our studio in Tulsa, Oklahoma, and this is your antidote to popular talk radio. Today, we are pleased and honored to have Mr. Michael Pinto as our guest. Michael is the president and founder of Pento Portfolio Strategies, which is a registered investment advisory firm that provides money management services and research for individual and institutional clients. He is a well-established specialist in the Austrian School of Economics, of which I am a student, and a regular guest on CNBC, Bloomberg, Fox News, and other national outlets. I personally listened to Michael during his interviews on King World News. Michael, welcome to our program. Okay, Michael, are you there? I can see you. Can you hear me?
Thank you for having me, Joseph.
Oh, thank you. Okay, I'm not sure if we're having are we having a problem with the an internet problem? Okay, we're having a little bit of an internet problem. I think because the lines are filled up or whatever. Well, but we'll keep on going.
Joe.
Michael, thank you so much for being a part. I know you're very, very busy. We're going to make this a short program. We appreciate you're taking the time out to be with us today. Michael, let me start by saying, last week, as I said, we had Gerald Celente on, and I'll just sort of summarize the way I see the world. It's very much similar to the way Gerald Celente sees the world. We have Europe in chaos for many reasons. And it's reminiscent of pre-World War I and pre-World War II. We have a global contraction, all right? We have also a high deficit, insane economic policies such as zero or negative interest rates and quantitative easing. None of this bodes well. All of this economic activity seems to be counterproductive. All the attempts to make peace in the world seems to be counterproductive. Where do you see us going from all this, and how does it translate to a financial point of view?
So you think there's a problem with having 30% of the entire developed world's sovereign debt having a negative yield, Joseph? I'm surprised. $7 trillion worth of sovereign debt trades with a negative yield. That's the real problem. We've created an epic bubble in all fixed income assets. We used to have a small bubble in internet stocks. When that burst, we had a small recession. And then we had a much bigger bubble, but that was confined mostly to the real estate sector. And when that burst, we had a global depression unfold. And we solved the problem by putting every bond on the planet in an unprecedented and intractable bubble. And when that bursts, you're going to talk about chaos and destruction, the likes of which we have never suffered through in history.
Yeah, I can understand that, because at least during we always compare everything to the Great Depression, and it wasn't as bad as people make it describe it, because although people didn't have money, we still had a relatively sound economy. We did have tariffs which restricted trade and whatever, but people eventually worked themselves out of it. Today, and there was a lot of latitude. There was hardly no debt whatsoever, and we had at least a currency that was quasi linked to gold. Today, we have more money. I mean, we're printing money like it's going out of style, and we have been for some time. Our unfunded debt is approaching $20 trillion. Our current debt is approaching $20 trillion. Professor Kutlikov tells us we're approaching $200 trillion in unfunded debt. We don't have any leeway anymore. So if, in fact, we have a currency crisis, what is this going to look like?
Well, first of all, back in the Great Depression, you had something called families.
Right, exactly.
Stuck together. I remember, my family used to talk about how everybody lived in the same house or in the same block, aunts, uncles, grandparents. So you had some kind of common infrastructure there. And by the way, everybody loved America back then too. It was so patriotic. My mother, I remember my mother, 75 right now, she used to make me stand up every time the national anthem was played. Now it's just, I think back in 69, we had about 2% of the entire American populace on food stamps, and now it's like 15%.
Yeah.
And, it used to be a shame. You'd be ashamed to collect money from the government, but now it's like, what can the government give me? So we don't have that family unity, and we don't have that common thread of patriotism that runs through our veins anymore. But you're asking what's going to happen now. Back in the 30s, we had hardly any national debt at all. We were relatively high on a household basis, but nothing like we have today. We have 335% total debt to GDP, total debt, household, corporate, and federal debt, and local state government debt is 335% to GDP. That's an all-time record high. This debt needs to be defaulted upon, but rather than do it the honest way and restructure it or cut the interest payment or lengthen the duration of the debt, we're defaulting on it through inflation. I gotta say, so, we talked about all this debt that has a negative yield. Over in Japan, they have a 10-year note that trades at minus 0.09%. It's almost minus 0.1%, which is unfathomable when you think about the 250% government debt to GDP. That's pretty scary. You have an insolvent government. By any economist will tell you, when you have 250% debt to GDP, your government's insolvent.
Right.
But you have a 10-year note that's minus 0.1%. And then you have on top of that this universal belief that growth comes from inflation. So you have Mr. I call him Hiroshima Kuroda over there at the Central Bank of Japan. He's printing money like mad, trying to reach inflation target, and central banks are always successful in hitting their targets. Then you're going to have an insolvent government with a negative 10-year sovereign note yield and an inflation target of 2% that's been achieved. So your real yield is going to be negative 2 point something percent. Right. Now you're going to have Mr. Kuroda selling trillions of yen worth of sovereign debt, and you're sitting there holding the bag with a minus sign in front of it. You're talking about a chaotic rise, a dramatic trenchant gap up in the level of borrowing, the likes of which we've never before seen, and what that does to Japanese stock market and economy. I don't have to tell you, it's going to be complete destruction.
Yeah, and we don't discuss much about the state debt, the municipal debt, which is, I don't know what the figure is, but apparently there are many states that are totally insolvent, are going to have a budget problem satisfying many of the pensions, which could never get paid because there just is not enough money. And some of the least wealthy states have the highest debt burden. Add that to the national debt, and we have a number that boggles the imagination. And then we talk about our infrastructure, which is in dire need, requiring trillions of dollars to bring it up to snuff, of which we're doing very, very little with. I guess I don't know where this is headed and what this place is going to look like, what this country is going to look like once the first person heads for the door. They're all sitting there having a great time, making believe that everything is fine, but everyone has that one eye on the door, waiting for the first person to walk out, and then everyone's going to follow because no one wants to be the last person in the room. And that's the way I look at our economy.
Yeah, well, the Fed is and the government is trying to convince everybody everything's normal. Hey, it's normal. People are buying houses. That's great. And if you could, as they say, fog a mirror, you could buy a car.
Yeah.
Number junk loans outstanding is horrendous, and no one's buying cars anymore. They're all leasing cars. So everything must be wonderful, except for the fact that we overlook that we are held together by the rubber bands and glue of 0% interest rates for 85 months. And that's going to continue. I don't consider 0.35% overnight lending rate between banks any kind of real interest rate. Right. So we're essentially giving money away for free for well over 80 months. And how does that all end? Well, it ends in a violent clash between inflation and deflation. So you're going to have wild swings between inflation and deflation, the likes of which we've never before suffered through in humanity. So we took what happened in 2008 when we had oil prices went from $150 a barrel down to $30 a barrel. Then they bounced back up to $100 a barrel when the Fed started printing money and raising the monetary base aggressively in 2009. Then it went back to, it had below $30 for a little bit. Now it's back up to, was it $40 a barrel right now? So the swings, what I'm trying to say is that the swings between inflation and deflation are going to become much more violent. Right. And what's going to bring that about is when the Federal Reserve switches from fighting deflation, which they're doing now, to fighting inflation. In other words, you remember that the Fed said, well, don't worry, now things are fine. We're going to raise rates 4 times in 2016. Well, they raised rates once in 2015 in December, and the economy fell apart, and the stock market fell apart. And that's really what the Federal Reserve is in business. That's what they're in business for. That's what they're all about. They're in the business of protecting banks and financial institutions and Wall Street. So that's when they really they got scared, and they went from going to be able to raise the rates 4 times this year to 2 times this year. And I believe before it's all over, they'll be going back into lowering rates and quantitative easing. And that's what you have to do. If you're an investor, and I manage money for a living and I provide research to institutions and individuals, if that's the business you're in, you have to be able to model the divergence between inflation and deflation and profit from it.
Yeah, it's interesting. Peter Schiff loves talking about the 1.2%, inflation rate. He said that he often wonders what would happen if it was 1.19, 1.9% and not 2%. Would that mean something terrible, catastrophic is going to happen? He doesn't know where they get these numbers from.
Joe. First of all, inflation is already on the core rate of inflation is 2.3%.
Right.
So it's already way above their target of 2%. But where did we as an American public buy the malarkey that comes from this unelected 12 member of the FOMC committee? Why do we believe that 2% is better than 1%? Or is it better than 0%? It used to be that central banks had a mandate of stable prices. Now somehow stable prices means 2% inflation. They're looking, this is a red herring, they're looking for an excuse for them to be so heavy-handed in markets. Why are they not draining their massive $4.5 trillion balance sheet? Why? Because they need to buy all this government debt to keep debt service costs manageable. If they actually unwound that debt, the government, the Treasury, would be paying $1 trillion in interest on the debt per annum. Right now, they just send interest to the Fed, and the Fed credits it back to them. So it's an accounting trick. Yeah. They're not paying interest on the debt any longer. Most of the debt is held by the Federal Reserve. That's why they're doing this. Why do you think the Japanese government, the Bank of Japan, is buying all of the Japanese government debt, JGBs, Japanese government bonds, because they can't sell them to the public at minus 0.1%. Right. No one would buy them. Yeah. And the same thing over in Europe. So there is no escape from this mess, and we are in a mess. It might look nice because people can buy a car or lease one, and they might be able to afford a house when interest rates are almost 0%. But this will not last forever. They're going to achieve their inflation targets. When the inflation targets are achieved, they're going to have to fight inflation, and that's going to cause a meltdown in stocks, by definition bonds, and the whole global economy.
Yep. Yeah. I've been following the economy for maybe 20 years. It's just something that I've been doing. I'm not an economist, but I've read many books. I mean, I have many people on the program who have written books, economists like Michael Tanner, from the Cato Institute. And so I'm a quasi, I guess it's a hobby, if you will. But I cannot imagine when there's the next correction, we cannot duplicate what we did in 2008. That would be virtually impossible. That's when the ship sinks. And when I say that, I really don't even know what I'm talking about, because I can't imagine how bad that would be.
I'll tell you what I wrote a commentary about it. It would appear on CNBC. It had 3,000 comments, hundreds of thousands of views. It's called a recession worse than 2008 is coming. And you can get that on my website, pentoport.com. What you're saying is beautiful. It's absolutely true. So to be more concise about it, in 2008, we took a Fed funds rate, the overnight interbank lending rate that was 5.25%. We took 5.25% interest rate down to 0. Now we have 35 basis points to take back. So if we enter into a recession now, what is the Fed going to do? They can't lower borrowing costs by hundreds of basis points. They can only take back a few. Nothing. And, deficits were about $200 billion prior to the Great Recession. The deficits during the height of the Great Recession in 2009, 2010 were $1.5 trillion. So where borrowing costs were $1.5 trillion more than our revenue. What happens if we have another recession? What happens if borrowing costs go back to where they were before the crisis? Yeah. You're going to have annual deficits that are way north of $1 trillion. Who's going to buy that debt? So, you have it nailed right down on that. Maybe you don't even realize how smart you really are, Joe, because you have it right. There's nothing the government can do this time around. So we are in a lot of trouble when the next recession becomes manifest.
Yeah. And when you compare what happened in 1980 with Volcker, when he raised the interest rate to 21%, and here we cannot raise the interest rate by 1/4%, that should be reason to bail ship, maybe move to Ecuador, give up your citizenship, just get out of Dodge. It's going to burn down. I find it actually scary. And people say, "Oh, you're a conspiracy person. I have a negative attitude, by the way. I want you to know that." And it seems like everyone's walking around like a zombie saying everything is fine. What I don't understand is that people are making less money today, have less disposable income today than they ever have had since the Great Depression. And yet the stock market continues to go up. And I go, who's buying all this stuff?
Real inflation-adjusted median incomes are down to where they were in 1995. So you're correct on the point that incomes haven't increased in real terms, but the stock market is up because the gamblers on Wall Street, they take their overnight lending rate, which is almost 0. They pledge some bonds. They get a bunch of cash at 95 cents on the dollar. And they go and buy and leverage up on more bonds and stocks, and they make money gambling in the casino. This is how Wall Street is functioning. And add to that the massive amount of corporate buybacks that have been engendered by these really low borrowing costs. So companies like IBM are borrowing money, even more than their entire net income, and borrowing that money to buy back shares, which increases the earnings per share and makes the stock market go higher. Yeah. But if you look at the stock market, real metrics like median PE ratios are a record high, price to sales is off the charts, total market cap to GDP is practically near an all-time record high. And earnings, by the way, are falling. We are in an earnings and profits recession. Yeah. So, if you're going to buy stocks, you better have one foot out the door and be very, very nimble and very quick, because there isn't a lot of bids out there. You have to know how to navigate. This is what I do for a living here. This is what I do. I'm short the market here. I own some gold. I own some commodity-based investments, and they're doing very well for us this year. Because you have to be dynamic and you have to be active.
Yeah. We're about out of time, but I need to ask you one question. If you have one more minute with us, please. Excuse me?
I sure do have a minute for you.
All right, thank you very much. How does China play into all this? Their economy, everyone looks to China as if China's success or failures or inflation or devaluation affects us directly. We have more problems than China, but yet we seem to focus on China. What's your take on that?
Well, my take is that China is an economy. I call them the Sino scam artists that are in Shanghai, that run Shanghai. So this is an economy that's a communist government. They peg their economy, their GDP, to the 100th decimal place. They manage their stock market to the 100th decimal place, and their currency to the 100th decimal place. This is not a very good economy. They have increased debt 28-fold, not 28%, 28-fold since the year 2000. They have more bad loans on their books, about $650 billion worth today, than we had in our entire subprime mortgage market circa 2006. This is an economy that's based on a huge fixed asset bubble that's crumbling. 55% of their economy was investment. You can't run an economy like that. There's no smooth transition from a manufacturing economy to a service economy. China accounted for 33% of all global growth, and that global growth extended to about 50% when you include the emerging markets. That economy is debt disabled and it's offline. There isn't any growth anywhere in the world: Japan, Europe, China, and the United States. So we're all in the same ship together. We're all going to go down this ship together unless you have a golden life preserver, which hopefully I can provide your listeners here at Pento Port.
Fine. Now, I assume that the dollar will eventually become worthless in the event of another collapse, because the government's going to be forced, their hands going to be forced to at least print enough money, flood the marketplace so people can at least maneuver a little bit, although the dollar will be worth much less than what's worth today, which is not saying much, by the way.
Well, by the way, I think the dollar is going to lose purchasing power significantly in the future, but I wouldn't look for it to become manifest against the yen so much, or the euro, or the renminbi. Look for it to lose its purchasing power against hard assets. So commodities and precious metals at the fore.
Okay. Do you have, before we sign off, because I know you only allotted 20 minutes to us, we appreciate that, but what advice do you have for our listeners at this point?
Well, you have to prepare your portfolio to get away from the modern portfolio theory. So if you're someone who's approaching retirement, you should have like 70% bonds and 30% stocks, and you think you're okay. You're not. Because there's going to come a time when central banks are going to be fighting inflation, and your bonds, which yield you almost nothing, are going to depreciate in value very rapidly, because they're going to be selling bonds to drain reserves. So bond prices are going to go down, yields are going to go up, and when yields go up on a debt-disabled economy, a debt-saturated economy like we have in the United States, China, and Japan, and Europe, the stock market's going to crumble right along with the economy. So do not think that you are safe having this bifurcated approach, this balanced approach of stocks and bonds, some kind of, ethereal mix between the two that's going to be magical. You have to be able to own alternative assets and be able to short the market and profit from its fall, and fall it will. Okay.
All right. Michael,
I can't hear you if you're talking.
Okay. There's a little bit of a problem with the internet line, the connectivity. So, and that's why we've lost you a little bit there. But we've overstayed our welcome. We want to thank you so much for being on our program. I'd like to give you the last minute or two to tell our listeners, about your firm and how they may reach you if you wish.
So the website is pentoport.com, www.pentoport.com. My email is mpento@pentoport.com, and the number here at the office is 732-772-9500. Please call us, and we'll be able to steer you through the tumultuous times ahead.
Thank you so much, Michael. I hope you will accept our invitation to return at a later date.
Thanks for having me on, Joe.
Okay. Thank you so much, Michael. Folks, this is the end of today's program. We'd like to thank our sponsors for the financial support, and we'd like to thank you for listening in. You can further the cause of liberty by recommending this program to your friends and let us hear from you. Our email address is comments@libertytalkradio.com. Remember, you're either allowing your liberties to be taken away or you're striving to protect them. Unfortunately, there is no middle ground. Until next time, this is Joe Cristiano. You've been listening to Liberty Talk Radio. Stay well. Stay tuned.